Roberto Campos Neto. He has completed an amazing mandate from 2029 to 2024 with a particular responsibility. I mean, the first governor to make the transition from one government into the other. A great Brazilian, took that responsibility very seriously, executed it very well during these 6 years. But most importantly, I think made a contribution beyond what a regular central banker would do. I'm not surprised that he received many awards and many recognitions as the central banker of central bankers. But I think the topic that he's going to talk about today is exactly his amazing contribution to technology, to productivity. I think it's a topic that is very close to his heart. So I think having started this revolution in Brazil in the payment system, including the PIX, open banking, financing, more inclusive financing, it's been really an extraordinary contribution. Other than just being, I think, one of the smartest traders that I know in Brazil, with a fantastic career, very successful chief financial officer at Banco Santander and other banks as well. So please join me in saying hello to Governor Roberto Campos.
Well, thank you, everyone. Thank you, Paulo, for the kind introduction. And I'm glad my task here is not to talk about monetary policy, not to talk about fiscal policy, but to talk a little bit about the change that we're going to see in the financial industry, in the banking industry, in the financial intermediation industry, to be more specific. I will probably start with a phrase that I think, if anything, I want you to remember that. I think the forces that we have in place today in terms of innovation will inevitably disrupt the traditional banking system as you know it today. And I'll talk about these forces, and I'll try to connect them to what we are seeing, and then we can explore a little bit more on the new things that is touching everybody's life, like cryptocurrencies, stable coins, so on and so forth. So what are the forces behind this disruption that I think is about to come on the traditional banking system? Well, the first one is the idea that banks lived for a while on transactional banking. So you have countries, for example, like Argentina, a while ago, only had 4% of credit. In terms of GDP, it was only 4%. A lot of banks just lived on the transaction. So the transactional banks still exist today. A lot of banks in Europe, you can still make money doing transactional banking. But when you look at what's happening today with all the movement of instant payments, the transactional part of the bank is going to be worth less and less. So this is one big change. The second one is the cross-border banking. The fact that you're going to have more platform banks that are going to become more international, they're going to be able to do more cross-border payments, that will also disrupt the industry as we know now. The third is the open data. I think we are going into a world of open data and open finance. And even though some countries are more advanced than others, I think there's going to be a global pressure for banks and financial institutions and governments to start adopting open data, because that reduces a lot of the asymmetry of information. The fourth one is the programmability of money. And then some countries will adopt CBDC, some countries will build platforms on existing rails, Bitcoin or some stable coins. But the reality is that we're going to have this programmability of money in one way or the other. And here we can make a strong case that this is happening already in many places. And finally, I think once we have all that in place, probably you won't have in your cell phone an app of bank A or B or C or D. We're going to see these marketplaces of finance in which you're going to have an app with all your data. You're going to be able to migrate your data from different institutions, and we're going to be able to compare the data, and we're going to be able to get more financial products at a cheaper price. So these are the main forces that I think will drive what I think is this disruption that we are seeing today in the banks. So let's start with instant payments. And instant payments, in the case of Brazil, we built Pix, which is now very famous amongst Brazilians. If we look at instant payments out there, we have 37 instant payment systems when you think about public solution. And we have more than 300 private solutions designed. In the US, you have a bunch of them. More and more in Asia, you have some of them. There are only 3 systems that are fully programmable. Only 3. Pix and another 2. When I say fully programmable, means that it supports smart contracts, that you can add new features, and you can use the rail with programmability throughout time. There's only 3. And it's very important, and you understand throughout the presentation, that the programmability is very important as we start to put the blocks of the innovation together. So the first question that always comes to our minds is, should we make the case that instant payments should be a public good? And that was a question that, Carlos was there at the central bank. We debated a lot. Should it be a public good? Should it be made by the government or not? And in some places, I was just in Argentina last week talking to people from the government, and they tell me, we don't think this is for the government to do it. We think this is a private thing. And I think we can have a second best, I would probably call second best solution, but we can have a solution when you have many different private systems, as long as you're able to connect them to some extent. When you look at what we have today, remember that we have more than 300 private solutions, and we have 37 public solutions. When we compare them today, one thing is for sure, when you look at the public systems, they have been able to diminish the cost of financial intermediation. They have been able to generate massive inclusion, and Pix is a big example of that. And they have been able, to some extent, to generate new business models, because once the transfer is very cheap, especially in emerging market countries, you start to make things that are very low in value, and you can actually do that using the system. So, bringing a little bit to a little bit of propaganda to my side, Pix was the fastest adoption rate of all the systems that I've looked at, all of the 37. We are close to doing 250, 260 million transactions a day. In Brazil, you have around 106 million bancarized people. So that's more than 2 transactions per bancarized people per day. So that's much more than India, for example. The other day I saw a study comparing the number of transactions of Brazil to India, saying that Brazil was the second place. Well, they only forgot to tell you the population in India is kind of much bigger than Brazil. So if you do per capita, Brazil is like 4 times bigger. Also, Pix is the one system that has been able to adopt the most numbers of new features. Because it's programmable, you can do new features. We have done a lot of new features in the system. Now we can pay by approximation. Eventually, you're going to be able to do credit card functions on Pix, because you will be able to reverse the payment to block the payment in a reverse way. And like I said, it's the most programmable Pix, a programmable system out there. So instant payments really is changing the way the banking, the transactional banking is doing. And we need to remember that one thing that has happened lately is the marginal cost of withdrawing money from one bank to the other is going to almost 0. It's basically 3 clicks on your cell phone. And this has a lot of implications for stability, for financial stability. And if you look at what's happening in Sovereign Bank and some other banks, you realize that when you have social media with influencers, plus the ability of withdraw money at almost 0 cost, you change a little bit the environment, especially when we talk about this new transaction banking that is emerging. So many systems are now many countries are now either creating new instant payment systems, like the US is doing the FedNow, or they're redesigning old ones. One thing is for clear, a lot of the systems that were not programmable are being upgraded to be more programmable. And this is one of the things that we discussed a lot from the very beginning when designing Pix. Without a programmable payment, it's going to be very difficult to achieve a lot of the progress of lowering cost of financial intermediation when you think about where this industry is going, especially with tokenization and programmability of money. Many countries are actually succeeding in linking private systems, but the effect has not been the same, and I think some people from BIS have produced papers on that nature. The effect has not been the same as the public platforms. So that's the first disruption, instant payments. Remember, I gave you a list of disruptions that are the forces that I think are going to disrupt the traditional banking system. Now we're going to the second one. The second one is the cross-border payments, the cross-border banking. And on this, we didn't have a lot of progress for many years. So I remember last time I was here, I had a slide with a multiple choice questions for the students, and the question was, what's the fastest way to take £1 million from São Paulo to London? And one of the options was by plane. And people thought that was a joke, but it was not. It was the fastest way, by plane. Because SWIFT was T+2, and all the other system was T+1. So you didn't have an intraday system, and you can do a flight between São Paulo and London in about 11 hours. So we have actually improved from that time to now. We have had some new solutions being offered by private banks, private platforms. We have B2B solutions. We have some kind of closed source mechanisms that are able to do that. But the thing that I think is really important for us is that we can make a case for a global platform to link all instant payments. There was a platform that was designed at BIS called mBridge that was involved in a lot of controversy lately. But the idea was we needed a platform to connect all the instant payments. If we can have PIX connected to CHIPS, which is the European PIX, connected to Nexus, which is the Asian PIX, there's a lot of gain from being able to do that. So the question is, why is it that we haven't been able to actually connect those systems? Why is it that we still use things that are T+1? I mean, here the explanation is a very interesting one, and I participated on this process all along. So in the first meetings when we were talking about that at the BIS, there was an idea that we didn't have the technology. So we said we don't have the technology. We experimented with some technologies. I'm not going to bore with a lot of technical details, but we experimented some technology that could link DLT systems to DLT. That was very good, very easy, very fast. Not very scalable, but it was done. And then we started to say, okay, but what if I link DLT to centralized system? It was not good. And we couldn't design a system that would be worse than what crypto does today. It was very slow when you design DLT from DLT to centralized system. Well, that technology actually exists today. Some people call it container solutions. You can now link any kind of system just as fast as any transaction you can do on a crypto platform. Okay? So we celebrated. We said, okay, we're able to do that. We can now link all the payment systems. Then we realized that it's not about the technology, because currencies, you actually need to do the settlement. And the settlement is sometimes complicated because a lot of currencies are non-convertible. So it so happens that there was a technology out there also that could be used, which is called liquidity token pool, which basically that central banks put money in a form of token in a pool for the week and for when the markets are closed, and you can do the settlement. So we celebrated again. We said, okay, now we have the system, now we have the settlement, let's do it. And then we realized that we didn't have the most important thing, which was the governance. You couldn't do it without the governance, because different countries have different criteria for AML, FTC. I'm talking about money laundering. The tax system is different in different countries. So in some countries, you are taxed whether you are a person or a company, or whether you are foreign or you are local, you were born in the country. And there was one other thing on the governance that was really a barrier, which is what we call liquidity gates, which is, would you be okay if you were a country linked to a system that had no limitation? So if your citizens wake up one day and decided to transfer all the money from their bank account to another bank account in another country should be able to do that. Or should you have some liquidity gates? So these three things were the things that, and I was heading this group at the time, these three things were the things that were in our mind. And to this day, we are not able to solve them. The last G20, which was a Brazilian G20, we really worked very hard to try to build a taxonomy. Because the only way to surpass this problem is if you have a taxonomy for a certain group of countries that agree on the money laundering criteria, agree on taxes, and agree on what are the liquidity gates that we want to have. Today, we don't have that. And that's the reason why we are not fully connected. And still, I think it's in intense debate, and obviously now with everything that's going in terms of the geopolitical, it's getting more complicated. But this can be done. The technology exists, the settlement exists. What we don't have is an agreement on the governance. And remember, this is an instant payment system. You cannot build truncations in the instant payment to recognize every millisecond whether someone is foreign or is not, or if your criteria, you can't do it. We are talking about millions of transactions in a second. You can do that. So I still think that this is something that we need to achieve. It will diminish the barrier of entry. For mid-sized companies, being able to do cross-border payments would be great, and we do need to create this solution. Now we are going to go to the third factor. So I mentioned first was instant payment, the cross-border business that is happening and is disrupting the traditional banking system. Now we're going to talk about the third factor, which is the open data. The world will soon realize that it's going to be very difficult for any kind of market to work without having some kind of open data regime. People more and more will be willing and will be able to sequester their data and to use the data. And you already have all these digital wallets out there that can capture data, you can monetize the data. This is something that is happening. And think about the first thing that I said. Eventually, you're going to have a super app. Eventually, in your cell phone, you're going to have just one app of a bank, and you're going to migrate all your data. In Brazil, you already can do that. We don't have a super app, but if you want to migrate the data from 3 banks to one other platform, you can do it. And a lot of people are doing it. In fact, as a matter of fact, we have 77 billion calls APIs, 77 billion attempts to migrate data from one platform to the other, and it's already happening. And I do it all the time. And you start to get calls from one bank saying, okay, I see that you have this and this product. Guess what? I can do better for you. And we're now seeing that the super apps are being built, and I think this is the future. On the top of that, the central bank standardized this process by building what we call the webhooks, which is once you initiate a search, there is a webhook that continues the search until you get a match, which means that anyone can plug into the system. If you have a niche company or if you're a segmented market, you can compete. So it diminishes a lot the barrier of entry, and I think it makes it more usable for everybody. One of the things that's going to change a lot, today the banks fight for the client, but they will be fighting for the channel, because the channel is going to be just as important. If you own the super app, or if you are a channel in which business are being done, or if you are the channel in which people are migrating the data from other banks to your channel, you have a comparative advantage. So this is starting to happen already, and we see that. One of the things that's very important is there is an intersection. I think this is very undervalued. I think this is the most undervalued innovation that we have in the financial world today. The intersection between open data and tokenization has a lot of value. And people, I don't think, are seeing the correct value in that already, still. For example, imagine that you have a super app and you have a tokenized system and you buy a house. You can, make it divisible, your house. You can program every piece of your collateral against a future payment, or you can auction a piece of your house, subject to certain circumstances, or you can do programmability on things that will happen in the future, or you can make an investment and say, if this investment goes this way, then I'm willing to do this other investment. You can start linking things. So the intersection between open data and tokenizing and a tokenized system is very, very powerful. And what has results? What are the results from that we're seeing? If we were able to have that, well, much lower cost of financial intermediation, the barrier of entry, segmentation would be, widely available because anybody with any kind of idea on financial service can just plug into a marketplace and start offering solutions for clients. Also, you're going to bring the traditional banking space more, closer to the DeFi space. Because once you are on a platform, the platform is a common rail, and you have atomized settlement, and you have DLT layers, you can start using products from the DeFi into the traditional banking system. So instead of doing what today the governments are doing, which is, pushing the DeFi system away, you're actually doing the reverse. You're actually bringing the DeFi system to a regulated environment, which I think is much better. And also the NBFI, which is today this big thing that everybody talks about, a lot of the banking activity is going outside banks. You're going to start seeing more and more this coming back through a global platform, because a lot of the tokenization can only be done if you have a common network. So being isolated today has an advantage because you can get lower cost of credit. But once you start integrating the systems, this will, I think, reverse a little bit. So that's the third point that I mentioned. The first was, again, just to remember, the first was instant payments, cross-border, open data, and now we're going to the fourth, which I think is the one that now is picking up, which is the programmability of money. And when I say programmability of money, it could be that some countries will use Bitcoin. It could be that some countries will have some kind of tokenized money. It could be that some countries will build CBDCs, and we have all these different initiatives. I think for a country like US that has a reserve currency, perhaps everybody's using stable coins on dollar, perhaps they don't need it. Some other countries will. I don't want to make the case that you should or you should not do it. It's happening, and the money is becoming programmable, and that's not going to reverse. That's irreversible. The question is what kind of programmability of money we will have once you interact these technologies. In Brazil, when we were designing our CBDC, which is called Drex, we started asking, do we need this? And when I had meetings with other central bankers, it was really hard on this debate. And I remember endless meetings at the BIS, because a lot of people said, no, we need CBDC because we need instant payments. You don't need CBDCs for that. We can do an instant payment system, and it's cheaper and works just fine. Some people said, no, we need the CBDCs for cross-border payment. No, you don't. You can link all the instant payment system. You don't need CBDCs for that either. Some people said, for some kind of B2B solutions, wholesale, we do need CBDCs. That's not true either. You don't need CBDCs for that. Actually, you have Nexus, which is a B2B system that's working just fine in Asia. What do you need CBDC for? Well, if you think that in the future, the programmability of money is going to be an important thing, and people will be able to tokenize their assets, either financial assets or non-financial assets, then you need the CBDC. You need the money that is an encryption format that will talk to the programmability of an asset in a tokenized way. And they will traffic in a platform, some kind of DLT platform. Then the question is, does it need to be public? I think there is a good question. There is a good debate around that. And like I said in the beginning, I don't know if it needs to be public, but I think it's important to go back a little bit on the debate of the CBDC, because I participate in that debate a lot. And we were a lot of central bankers in a room, and if you are in an emerging market country, you start wondering, okay, do I want to have a CBDC that changes the asset and liability of the balance sheet of the central bank? And the question is, no, I don't. So why don't I want to see that? Well, because that will probably disintermediate banks. As people switch from physical money to the digital money, you're going to have an account at the central bank, and that's going to disintermediate bank. So if people think that the digital currency is always better than the physical one, and they want to switch, a big amount, this is going to create a big disintermediation for banks. And I remember that I was one of the ones that posed that question, and the initial reaction is, well, we can limit the amount of money that people can switch from physical to digital money. And at the time, I was thinking to myself, imagine that we have that rule in Brazil, and all of the smart people realize that this is always going to be equal or more, and then everybody, try to cash out and transform their physical money to digital money at the limit, and then I have to go to Congress and explain that we created a system that the smart people are making money because now the digital money is trading at a premium. That would never work. So there was another solution that was proposed by some central bankers from Scandinavia, which is, well, you could have a negative interest rate on the digital currency, and then you can equate demand to supply. Well, imagine calibrating an interest rate for that to happen on the short term. That would be very difficult. And this question of how to do a CBDC involving changing asset liability composition of the balance sheet of the central bank without disrupting the traditional banking system, disintermediating credit, that was never solved. To this day, nobody knows the question for that. And then we were thinking about that at the central bank one day, and we said, okay, but we have a solution. Why don't we just do a tokenized deposit? Why don't the banks just block a deposit and issue a token on that? In that way, you don't have the disintermediation. And there is a lot of benefits from doing that in that system. And I remember I gave a presentation, with that idea at the BIS with all the other central bankers, and nobody really liked the idea. People said, no, this is very strange. This is just like a token deposit. And then after my presentation, Agustin Carstens, which was the general manager at the BIS, came after me and said, Roberto, I like your idea, but I think, tokenized deposit is a horrible name. So I'm going to write a paper, I'm going to call it Commercial Bank Digital Money. And I said, you can call it whatever you want as long as you like the idea. And the reality is the paper was written, and all of a sudden we have 7 central banks now that are doing exactly the same. And the idea is there are a lot of benefits from doing that. One of the main benefits is you don't need new regulation. You already have regulation for deposits. You just have deposit prime, which is a digital form of deposit. So you don't need to change a lot of the law. So it makes it very simple. One other thing is that once you insert the tokenization concept in the balance sheet of the banks, they will stop look at asset liabilities in an account way, and they will look in a token way. That's very, very efficient. Today, there are tests being done in banks in which if you look at the risk analysis, collateral analysis, funding, everything is being done more efficiently when you do it in a tokenized system than an account system. So the banks will be able to be more efficient if they look at assets and liabilities more in a token way. And this is what the DREX will do in Brazil. One other thing is diminish the friction between buyers and sellers. If you imagine that we're going to have a hyperledger bezel, which is the one that we use in Brazil, you can do others, and all the assets are going to go into the hyperledger. They are verified at some point in time, they go into the hyperledger, and then you don't have that friction because it's instantly verifiable. You can do division of collateral. You know where the assets is. We know how much of it is being compromised by previous operations, so it's very transparent. So if you buy an apartment here in the US, for example, I always give that example. A lot of people have done that. You need a escrow account. It's a very cumbersome exercise because you have a escrow account, you have a lawyer on one side, a lawyer on the other side, or buying a used car in Brazil is very tricky because you don't want to sign the check before the document is in your name. On the other side, the guy looks at you and says, I'm not signing the document before I see the money. So, all this, friction can be resolved on a DLT like exercise. One of the things that we can do is we can create links between the private and the public programmable money, which is something that we are seeing now and now more. And I think this is kind of the future for a lot of the developed markets. So then the question is, let's explore a little bit more some of these things that are happening. And probably I will start with stable coins, because I think it's important to differentiate between stable coins and cryptos. If you look at stable coins today, 99.6% of it is dollar-based, right? And you only have 2. I mean, I don't want to go into the very technical details of everything. But it has had a huge growth. In Latin America, the stable coins are growing so much that we had to change the accountability because it was affecting the trade balance in a way that was difficult to explain. And I think Carlos was still there when we did the change. And then the question is, why is it that stable coins grow so much? Well, it's very simple. It's a very cheap way to have an account in dollar. If you want to open an account in dollar in Brazil or Argentina or in most of emerging market countries, especially the ones with non-convertible currencies, you have to have a big amount of money. You can't open an account in dollar. Now you do have these platform banks that you're able to do less, but a lot of people still prefer to be anonymous. So you're having this huge growth in stable coins. When you see the huge growth in stable coins, I think three things become a problem. And this is what we try to do in the regulation. First, you want to have segregated accounts. You want to be able to see on an account base, how much everybody has of stable coins. You also want to have segregated collateral. You want to see that if you buy X stable coins and it's based on dollar, I want to see that that collateral is sitting in a place and it has your name. And also, we don't want a lot of concentration in custody. We saw what happened with FTX and some of these experiments. So today, I think this is growing. And as long as you touch these 3 points that I mentioned, you can make it grow in an organized way. It has become a source for young people to have an account in dollar. But I think there is here a space in which the banks have not touched, which is connecting the stable coins environment to banking. So, like providing solutions so that you can cash your stable coin into a debit card or a credit card or things like that. This is some things that now some banks are working on it, but I think still the banks are too much away from this innovation, not understanding that there is a lot of space if you can connect the user of stable coins and crypto to the traditional payment system. Because again, a lot of these things, they serve sometimes as a digital asset, sometimes as means of payment, but you are not really connected to the retail system yet. When you talk about crypto, I think it's a little bit of a different conversation. Today, there is this idea that you can change the regulation in a way that you understand crypto as a digital property. And this is what is being debated a lot in DC these days. I'm not so sure, what is the impact of that. But if you consider that owning a piece of the network is a digital property, it changes a lot of things conceptually. I'm not very convinced that this is going to make it be worth much more than it is today. But I think it changes a little bit the way people see the ownership. One other thing that I wanted to touch is this DeFi space. So this decentralized finance space that we're seeing growing a lot with other instruments. You now have digital currencies that are a combination of cryptos or a combination of cryptos and stable coins. And you emerge with the old concept that we have as bank as a service, but now you have bank as a service in a digital way. And I think everything is telling us that these platform banks are going to have more and more space. But then when you talk about all this innovation, we still have two things that we haven't touched. And there are two problems. One actually is a problem that we face in the development of DREX, and it's actually a problem that many DLT platforms have, which is today we do not have the technology, to have scalability and privacy at the same time. If you want to have a lot of scalability, you have to give up privacy. And this is a problem because these systems were created by people that want every transaction to be known to everybody. So we want to get this system that was created for that reason and twist it around in a way that we have privacy, at least for part of the transaction. And the solutions that are being given to that problem work only for a small amount of operations, a small amount of transactions. If you scale up, in most of the things, you collapse the system. So this is, I think, probably the most important thing is going to happen in the next couple of months. And I think we are very close to a solution to that. We went from token shield to 2 layers to 3 layers. I don't want to go into the technology too much here. But once you solve that problem, I think you're going to be able to have a bank that's not a digital bank. It's a tokenized bank. And I think it has a lot of different implications. The second thing that we actually haven't touched is what is the role of artificial intelligence into this new space in which you have programmability of money, you have DLTs that interact between one another, and here you can look at one paper that was written by Bursztyn. It's called Finternet, which is a future conceptual world in which you have many hyperledgers that interact amongst themselves. It's a very good paper. It was written by Bursztyn and by this professor from India called Nikelani, and I think it explores this a little bit. So some predictions for the future. My main prediction is that traditional banks will be disrupted by platform banks. It's happening already. It's going to accelerate a lot in the next 2 years. You can see examples of that everywhere. You can see Nubank in some places in emerging market countries. You can see Revolut in Europe. There is a platform in the US that's doing very well. It's called Mercury. You're going to see more and more of that because you're going to be able to give services to client at a much lower cost. The cost of acquisition of a client, the cost of maintaining a client in a platform like that, especially when you start linking to the DeFi space, linking to stable coins, linking to other instruments, I think this is here to stay. One other thing that it's also in the Finternet papers, DLTs will be more important for the process of financial intermediation. You might think it might take longer, or it's not, but it's here already. Look at what we're seeing in a lot of these new developments. It's happening already. Look at the number of companies that are doing solutions between stable coins and hyperledgers. So this is already here. So I probably end this saying that tokenization will be an important part of the financial intermediation process. I think this will actually put a big stress on the traditional banking system as we see it today. You're starting to see that a little bit, but I think it's going to accelerate a lot in the next 2 years. Thank you. Sure. So here, probably there is another question before that, which is, if you think that the means of payment will be a digital currency that won't be created by the central bank, it has a much more profound implication. If you just think that the system will be tokenized and the system will be interlinked in a digital way with either money or derivative of money created by the central bank, then it will change the velocity of money, it will change some of the competition in the landscape, but it won't change too much or won't be too profound in terms of monetary policy. Now, if you believe that people will start paying things and doing things with Bitcoin or Solana or all the cryptos, then we have a big challenge. But today, when you look at the growth especially in emerging market countries, which are using more and more the digital space, because in the digital space, in financial intermediation, emerging marketplaces are more evolved than, and I mean, here we can just go around here and you see that you still write checks in US, right? The question to you is, I don't think that, non-traditional, I don't think that digital money, not issued by the central bank, will have a profound role in terms of means of payment anytime soon, but it could happen. And if it does happen, it has profound implication, would be another presentation. Professor Marcos has done a lot of work on that. We had the other day a seminar that we talked a lot about that. I don't think we're going to get there now. I think before that, you have a huge disruption happening just using digital forms of money that are backed by central bank money. Okay, done? Thank you.
Good afternoon, everyone. It is my great pleasure to introduce our next keynote speaker, Professor Leonardo Bursztyn, a distinguished economist and professor at the University of Chicago. Professor Bursztyn's research provides critical insights into how social forces shape individual decision-making and economic outcomes. His work is particularly relevant in a world where rapid digital transformation, evolving social norms, and new economic challenges redefine how individuals, businesses, and policymakers interact. Professor Bursztyn's academic journey began in Brazil, where he got a master's degree at the University of Brasilia before pursuing further studies abroad. He then earned his PhD in economics at Harvard University, completing it in 2010. After his doctoral studies, he joined the UCLA Anderson School of Management as an assistant professor. He later moved to the University of Chicago, where he currently holds the prestigious title of Sayre Family Professor of Economics in the Kenneth Griffin Department of Economics. In addition to his professorship, he serves as an editor for the Journal of Political Economy, co-directs the Political Economic Research Initiative and the program in behavioral economics research at the Baker-Friedman Institute, and is the founder and director of the Normal Lab, which focuses on understanding how individuals' economic decisions are shaped by their social environments. Professor Bursztyn has made pioneering contributions at the intersection of development economics, political economy, and behavioral economics. His research focuses on how social environments influence individual choices, particularly in areas such as education, labor markets, financial decision-making, and political behavior. His work has been published in leading economic journals, including the most famous. Beyond his research and teaching roles, Professor Bursztyn is actively involved in several esteemed research organizations. He is research associate at the National Bureau of Economic Research, a fellow at the Bureau of Research and Economic Analysis of Development, and an affiliate at the GPAR. One of his most influential research streams explores the role of social pressure and peer effects in shaping economic behavior. His work demonstrates how individuals often adjust their decisions, not just based on personal preferences, but on how they believe their peers will perceive them. This insight has deep implications for foreign design, policy design, education programs, and economic development initiatives. For instance, his studies on education have shown that how students' performance and career aspirations are significantly shaped by social norms. His research suggests that in many settings, young people may underperform or underinvest in education due to concerns about social status and peer perception. These findings have significant policy implications for education reforms, particularly in emerging economies such as Brazil. Another critical area of his research is the impact of social networks and media on political engagement and belief formation. In a world increasingly dominated by digital platforms, Professor Bursztyn's work sheds light on how exposure to different forms of information, particularly on social media, affects economic and political choices. This is especially relevant in Brazil, where the digital landscape has a significant role in shaping public debates and political participation in recent years. Professor Bursztyn's research connects directly to the themes of his conference. His work helps us understand how individual choices, shaped by social influences, impact broader economic and political systems. In an era of rapid digital transformation, his insights into how social pressures, misinformation, and network effects influence decision-making are critical for policymakers, business leaders, and academics alike. Today, Professor Bursztyn will discuss the social media trap, a timely and urgent topic. As digital platforms increasingly mediate our political, economic, and personal lives, understanding their effects, both positive and negative, is more important than ever. Although his presentation is not specifically about Brazil, its insights have special resonance for the country, where, as in the United States, social media platforms play a pervasive role in daily interactions. It's a privilege to have with us today a scholar whose work combines rigorous economic analysis with real-world relevance. His research challenges us to rethink how we approach education, public policy, and governments in an era where digital interactions increasingly shape individual decision-making. Ladies and gentlemen, please join me in welcoming Professor Leonardo Bursztyn.
Thank you so much for inviting me. This is an amazing day. Great to be here. This will take a little bit of a gear shift in terms of the topics, and thanks for the really kind words. Though this is not really exactly about Brazil, I think this is a topic that I think is pretty relevant in Brazil and basically globally. So I'll get started. This is, I guess I'll Hello? Yes, perfect. Okay, so this is the social media trap. This is based on a recent paper, and I'll get started. So there is a little bit of a puzzle with social media. On the one hand, people spend a lot of time on social media, particularly young people. A teenager spends about 4.8 hours per day on social media. In Brazil, it's even higher. Brazil, I think, is the #1 in terms of amount of time spent on social media per day. There's one item that takes more time per day, which is amount of sleep, okay? After that, it's social media nowadays. So if you look generally in the population, it's about 2.5 hours per day. And they seem to really value it. If you ask people how much they need to pay you to stop using social media, you have to pay them a substantial amount of money. Right? So people spend a lot of time on social media, and you have to pay them substantially to stop using social media. So you think, well, okay, so it's probably something good that they value a lot, right? They spend a lot of time, and you have to pay them to stop using it. On the other hand, there's more and more evidence of the negative effects of social media, particularly on mental health, right? And if you look at, there's a whole discussion now about the effect it has on the youth. A lot of countries are adopting initiatives of banning phones and so on. There's a big movement. I think in Brazil as well, there's a recent movement about banning phones in schools and so on. There's a big debate now and growing body of evidence on the negative effects of social media, right? So there's evidence that they worsen mental health, and they also contribute to digital addiction. There's recent body of evidence. These are 2 recent papers in the AR making that point. So why? So why are people spending so much time, okay, and they have to be compensated to stop using something that clearly is making them feel worse? At least a lot of people are feeling worse because of that. Okay, so what I'm going to describe here is kind of a take that we develop in this recent paper, where we think about product markets as potentially collective traps, and it's particularly relevant in network goods. They're becoming more and more relevant in this digital world. So let's build the argument in steps here. In some cases, not using or consuming a product that others are consuming might make you feel bad, right? So everyone is consuming something, you're the one not consuming it, you feel worse off, okay? For example, you may feel socially isolated, okay? Everyone think about social media, everyone's on social media except you, so you feel worse off because everyone's interacting there, everyone knows what's going on. You're missing out, you're isolated from the conversation or from the memes, from the trends and everything else. So given that everyone else is using it, you feel worse off if you're not using it, okay? Then you may actually start using to avoid feeling this cost, right? Feeling socially isolated. You said, okay, I can't really afford to be the one out, so I'll join the network, I'll join social media. But you might actually prefer that the product never existed in the first place. So given that everyone else is using it, the best thing I can do is to also use it. But if I could choose, I would actually prefer if no one were using it. That's not really my choice, right? So you still use the product, even though you prefer that the product didn't even exist. The use of the product by others creates a cost to you, and the only way to avoid it is by also using the product, right? So that's theoretically the situation we're describing. So typically, when we're considering the welfare associated with a product, we usually consider how you feel compared to not having the product. So we compare you consuming the product, given that everyone else is consuming, versus you not consuming the product, instead of comparing to a case where the product doesn't exist, okay? So let's think about social media to give a little bit more flavor to this argument, okay? So consider TikTok and Instagram. Those are extremely popular among young people, right? Those are the two most popular platforms. I think it's the same in Brazil, right? They dominate among the youth. It's actually pretty painful for a young person to not be on social media when everyone else is on social media. They might experience what we call fear of missing out, or FOMO, right? They don't know what's going on, they feel this anxiety, and they might actually be legitimately excluded from a lot of social interactions. People communicate in those platforms. That's how they stay up to date with their friends and so on. So it's actually pretty costly to be the one not using these platforms. So the question we ask is, could it be that large numbers of young users of these platforms do not want to stop using them, given that others are using them, but at the same time we prefer them not to exist? In other words, is there a social media trap? Okay, so that's the question we decided to ask here. Like, could we be, this is an interesting argument conceptually, but is that empirically relevant in this important market? Okay, so that's what we try to understand here. So just to develop a little bit the conceptual idea here, right? So it is costly to be a non-user. So as I mentioned, if others are using it, it's costly for me not to use it. So the typical way that people use to measure the value, the consumer welfare associated with social media, and there are lots of papers about doing this, is how much you need to be paid to stop using social media, given that others still use it. And that will say how much you value it. So you need to pay me $50 or $100 per month to stop using Facebook or Instagram. The conclusion is that I value Facebook or Instagram a lot. You have to pay me $100 to stop using it. So if people need to pay a lot, it means that social media creates a lot of welfare to its consumers. That's the conclusion. In fact, there are papers urging policymakers to start adding this to calculations of GDP, right? To say, oh, there's a lot of value being created by digital platforms that we're not taking into account, using this type of calculation. Now, what I think it's more appropriate is to do the product market valuation. How much you value the existence of the product market, right? So many people may need to be paid a lot to stop using social media by themselves, even though they would prefer that the product didn't exist. So does that mean that the product is creating value to those people just because you have to pay them, given that they're part of a network? Okay, so that's what we're going to try to study here. We're going to focus. I'm going to show you results from some experiments we ran with college students. One of the most relevant group in terms of social media usage, similar in Brazil, this is common in every country. Among the heaviest users, there's increasing rates of depression, and they're typically associated with increasing social media usage. So I'm going to show you some results from these experiments we ran with large samples of US college students. Okay, the first thing we can do is just ask them a simple question. That's just to motivate as evidence. Do you prefer to live in a world with or without TikTok or Instagram? What we find is what I thought was pretty stark, is like, for example, if you ask Instagram users, 57% of Instagram users prefer that Instagram didn't exist, okay? So they're using Instagram, they're using it a lot, but they would prefer if the platform didn't exist. Imagine this for another product, refrigerators. 60% of people who own fridges would prefer the fridges didn't exist. That sounds kind of crazy, right? So that's the situation that we're facing right now among the youth when they're thinking about those platforms. When you think about TikTok, so you still have about 1/3 of the users that actually wish TikTok didn't exist, yet they're still using it frequently, right? If you include non-users, it goes up. So if you don't use TikTok, you really hate the existence of TikTok, right? So a lot of TikTok users also do that. Okay, so of course this is just to build the evidence with survey, just asking the question, but as economists, we like to believe in revealed preference, in costly choices, right? So we ran some experiments. I'm not gonna go in a lot of details for interest of time, and I also don't wanna bore you too much. But we did develop this methodology with this willingness to pay experiments where first thing we measure is how much you have to pay someone to deactivate their TikTok and Instagram account for 4 weeks. So how much, how much I have to pay to do this, right? And it's incentivized choice. There's a chance that we implement it and we verify compliance and so on. We follow how the literature typically measures that. And as I said, this has been done before, and that's how people typically stop to establish the value, the consumer welfare associated with social media. Then we do another type of elicitation, the second step, which is how much do you need to pay the users to deactivate their TikTok and Instagram account for 4 weeks if they think that a lot of their classmates, the other people in their school, will also deactivate, right? Just try to get the measure of network effects here. Like, how much I need to be paid to stop using this platform vary a lot depending on whether others are also being asked to deactivate, right? If yes, of course, that confirms that there are indeed these network effects. But what we're really interested in is the third step, which we call the product market evaluation. So suppose that now you're the decision maker. Imagine this situation where I get to decide whether my university keeps these platforms or whether I press a button and I deactivate it for everyone for 4 weeks, right? What would I prefer to happen? And how much am I willing to pay to get to be in either one of these situations? The situations where we keep things as they are, or I press a button and no one can use these platforms, including myself. So we do the willingness to pay elicitation in that scenario, and we incentivize it. Okay, so trying to simulate the situation with real incentives to see what these people would prefer. Okay, so here's what we find. So how much do I have to pay someone to stop using, a student to stop using TikTok and Instagram for 4 weeks? Well, you have to pay them quite a bit of money, and that is consistent with other findings from the literature. On TikTok, you have to pay a user about $55 for them to deactivate their account for 1 month. Okay? For Instagram, it's about $47. So you could stop here and say, here, yet another piece of evidence indicating how much value these platforms bring to people. You have to pay a person $50 to stop using them for a month. So that's a lot of value, creating a lot of welfare. In fact, that's how they're framing it, the platforms in a lot of the research. So if you keep going, we already see that if you anticipate that others in your school will also be asked to deactivate, how much you have to pay you already goes down. Okay, that's not super surprising. That's measuring these network effects. How much I enjoy being benefit I get from a platform depends on who else is on the platform. After all, those are social networks. Those are social media platforms. Now, when we try to measure how much they value the presence of the product on campus, right? Whether they prefer the product to continue or to get rid of it, what we find is that the same average person you have to pay $55 to stop using TikTok is willing to pay $24 to get rid of TikTok, right? So you get this very interesting pattern where the same person that needs to be compensated to stop using a product, given that everyone else is using it, is willing to pay to get rid of the product, right? So that changes how we think about the welfare associated with these platforms, right? Because suddenly you start thinking, are they really creating value? Are people really better off with the existence of these platforms, or are they just trapped, given that everyone else is using it, right? So that's the question we're asking ourselves. Actually, if we include non-users, even more negative. So it creates this big negative externality to non-users. Non-users of TikTok really hate the existence of TikTok and are willing to pay more money to get rid of TikTok, right? So if you start aggregating both users and non-users, you start getting pretty negative numbers associated with, in terms of the welfare associated with this platform, okay? So I think that really kind of starts building this case that perhaps it's not creating a lot of positive value. If you want to think in terms of just, if you don't want to worry about the numbers, the values, just want to look at the directions, what we find is that 60% of TikTok users in our sample would like to get rid of TikTok for a month in our data, okay? 60%. If you include non-users, this is 70%. Those are very high numbers. For Instagram, it's about 45, 50%. So, you know, between a half and 2/3 of users actually would like to get rid of those platforms. Okay? That's what we find among college samples, knowing that those are among the heaviest users of social media. We do some other, I'll skip that quickly. we try to argue that this is not just something mechanical from the elicitation or just kind of some overall repugnance toward digital products. If you do the same experiments with Google Maps and Waze, guess what? No one's willing to pay to get rid of Google Maps and Waze. They actually like it, right? So it's not something that is there for every digital product. It's something about some specific digital products that seem to be trapping people. Now, if you ask people why is it the case that you say you prefer the product not to exist and you still use it? And we ask these open-ended questions, right? And we use ChatGPT, or we can code ourselves, like the types of answers they give to, just so it's completely open-ended, we're not prompting them. And if you look at the reasons that are mentioned, especially for Instagram, 76% of them mention things associated with the fear of missing out, FOMO. They just like, yeah, if I'm not on social media, I'm gonna miss out, I'm not gonna know. If I stop using it, I'll be completely out of the loop. So things that kind of build this case that, yes, they understand that it's causing them harm, but given that everyone else is doing it, the best thing that I can do is it could be pretty rational, right? The best thing I can do is also use it. So that's really the number one motive for TikTok as well. Some people evoke addiction as a potential reason, especially for TikTok. It's consistent with the evidence that people really just doom scroll on TikTok. They just get addicted and so on. But a lot of people mentioning things associated with the fear of missing out. And then, again, if people, how they would feel if they activated social media and everyone else still did it. They also mentioned similar feelings of missing out. So, if you look at the open-ended evidence, it really is consistent with our story. So I'm going to conclude, but also talk about a bunch of other stuff that we're building based on that, okay? So we find evidence based on this methodology that a lot of people who use social media would prefer social media not to exist, and they'll be willing to pay to get rid of social media. So that calls in question traditional measures of welfare associated with a lot of these digital platforms, because a lot of the digital platforms, you actually don't have to pay to use it, right? It's not like how much you're willing to pay because you have to pay a price to use it, right? So technically, they're free in that sense. But what we're trying to argue is that when you have these big network goods, of these big network effects, what could be happening is that at some point the network is so big that you don't really have a choice, but you have to enter and join the network. And perhaps people that would prefer the network not to be there actually have to join the network because everyone else is doing it. This has interesting policy regulations, and I know that this is now being incorporated in a lot of the FTC discussions because, let's just say I know, and because when networks become too big, people might actually not have a lot of choice, and they might have been kind of forced to join networks. And if we think about this, a lot of times platforms might be introducing new features that might not be making the product better, but they're just making not having the product costlier. And that's the type of stuff that policymakers and regulators should be looking at, right? For example, Instagram introduced direct messaging and really pushed that in their platform. So that means that now if you're not on Instagram as a kid, you're not even going to be able to text with your friends. So that your friends, that really raise the cost of being out of the network, right? So that's one example. Another thing that we're studying now, we're putting out the paper next week actually, is in cell phone communication, right? So this is particularly relevant in the US because in Brazil, most people use WhatsApp, right? In the US, for a number of reasons, and I think that's one of them, people who have iPhones, they use iMessage to communicate, right? Turns out, if you're using iMessage, you can tell if the other person is an iPhone or is an Android, right? If you're texting with an iPhone, it shows up as a blue bubble, right? And if you're texting with an Android, it shows up as a green bubble. You might be thinking, well, it shouldn't matter so much, right? So the first thing is that Apple refused to adopt the same standard of communication as Androids, right? Which is RCS. So the communication was actually worse with Androids, right? So there's an ongoing DOJ case against Apple, and Apple in the last iOS update actually implemented the same standard in the US and Europe. But they kept the green bubbles, right? Now, you might wonder, why is this happening? Now, if just zoom out a little bit, among young people in the US, the market share of Apple in this market is about 80%, okay? So we decided to study this because our hypothesis is this was actually creating a lot of costs to not being an iPhone user. And if you look at the news in the US, there's a lot of discussion about the so-called green bubble culture. Kids feel excluded when they have green bubbles. There's a stigma associated with it. Of experiments showing how this creates a lot of stigma. For example, 90% of college students in the US believe that there's a green bubble stigma, which creates stigmas for Android users. They notice it's very salient. Interestingly, about 80% of Android users and 2/3 of iPhone users want the green bubbles feature to be completely removed. So iPhone users themselves don't like that, and they would like it to disappear. Apple, of course, keeps it. They don't think that the phone would be worse if you removed it. So it's a type of feature that is not making having an iPhone better, is making not having an iPhone worse. And that is extending Apple's market power, right? So you're extending your market power not by making your product better, but by making not having your product worse. You're changing the utility associated with the outside option. So, iPhone users actually require a lot of money to deactivate the green bubbles. About 70% of the disutility, of the amount that they're required to deactivate iMessage, about 50% of the value of a camera. If you ask them how much you need to pay you to just become green for a month, okay? And then when we run these experiments, choice experiments, we see that the Android market share would go up about 46%. If Apple got rid of the green bubbles, right? So it's really, really creating market power, not by creating utility to the users, or by creating disutility to the non-users. So here's another example of these really big companies, big tech companies have these big network effects that might actually be creating a lot of market power, not necessarily by making people better off. So it's just another example here that we have. Now, another thing that I wanted to discuss is like, we could have a whole discussion here about regulation, right? Oh, okay, what should we do? Should we ban these products? Should we ban social media? I don't think that's necessarily the solution. And as a Chicago economist, I was thinking, okay, well, there's some issues with the market, but the market can come up with solutions to market problems, right? So the obvious solution to the social media case was like, okay, there's a coordination problem here. We have a prisoner's dilemma where people stuck in an equilibrium and you'd like to move to another one. So if you take this lesson seriously, what needs to happen? We need to create a coordination tool. If it's hard for me to use social media less because everyone else in social media, it would be easier if I could coordinate with other people. That didn't exist. So I was on sabbatical and I was like, okay, what I'm gonna do, I'm gonna create an app. So I decided to create an app that allows people to coordinate and spend less time on social media. So my original goal for the sabbatical was to write a book. Instead, I launched a startup. And we raised money and we developed this app called NOMO instead of FOMO, no missing out. It's like just to show people join these challenges with their friends to spend less time on social media. So it's easier because you're not doing it alone, you're doing it with your friends. And we gamify, we do a bunch of stuff like that. And the interesting thing is that the app not only helps people spend less time on social media by coordinating with their friends, but it also helps them spend more time elsewhere, right? So it's just shifting time from social media or doom scrolling to other activities. So they win these challenges, they get points, they unlock rewards. And that becomes a business because a lot of brands also want to gain access to people's time and are struggling because of social media. So these brands pay us to gain access to people's time, right? Think about the movie industry. You're Warner Brothers. Because they're on social media. So a lot of industries are funding their own irrelevance by buying ads on social media, right? It's a pretty cruel business, right? So that's why when I have a call with these companies, it's pretty easy to convince them. That, instead of taxing people's time to to be the middleman in terms of getting the attention, I'm going to charge a negative tax rate. I'm going to free up people's time and send it your way. So anyway, I don't want to pitch too much. Anyway, but that's where we've been up to. And we've been doing campus trials in the US. This is the one we did at UCLA, where you get all these people dressed like thumbs, to free the thumb, and the kids get crazy with that. So we actually showed, for example, at the University of Chicago, that it really works. People really stop using, cut down the usage of TikTok and Instagram when they are in those challenges. And more importantly, we measure pretty big mental health improvements. So when you look at people who actually spend 2 weeks using these platforms just cutting to less than an hour per day, we see, for example, the incidence of feeling of depression goes down by close to 50%, for example. So really, they seem to be trapped and spending a lot of time on things that are making them feel worse. And simple things like coordination tools, there could be market solutions to these market problems. We don't need necessarily to rely on excessive government regulation. So that's how I wanted to finish here. Thank you. Schizophrenic monster here, right? Very different topics.
Thank you, Leonardo. I think it's absolutely fantastic that what you presented. I wondered what is the role of the price system here, because you in a way you create incentives and disincentives. And, I think it's pretty striking that the people that are not using outside of the network, suffer a negative externality and are willing to pay, so others would stop using it. But it's like a cause arrangement where they can actually pay to derive what seems to be the societal best outcome. And the other thing is, preferences are what they are. And we're not in the business of being the great educator of people's preferences, right? To which extent, the green versus the blue banner that identifies the user, that creates a little bit of discomfort of those that have Android versus Apple, that should be actually be involved in that business, it's what it is, it's a preference, whether you should, be involved in that business at all, from a preference formation standpoint.
Great questions, thanks. On the first one, it's pretty hard to create this side market, right? Because the problem is that the only way to become affordable is to be able to bribe a lot of people together, right? Which is a little bit what we're doing with the app. It's like creating the coordination. Otherwise, you have to pay each person a lot of money to stop using it. But what we found interesting here related to this is the fact that people are aware of the trap, right? Even young users. For some people, the most surprising thing is like, well, they're actually pretty aware of the situation and they're willing to pay to stop it. On the second one, yeah, I'm not trying to say, hey, we need to just ban those features, it's a problem. All we're trying to say is that indeed there are cases here in which market power is being sustained by unambiguously lowering the welfare of users, right, of the population. So there is an ongoing case, DOJ, and that's actually a central part of the case now. The antitrust case with Apple is the green bubbles. And that kind of contributes to that discussion, which is, hey, you have a lot of market power at first, and you might be kind of making that market power be extended, not by making a product that is better, but by making the experience of not having a product more miserable. So again, it's just a discussion. I think it's relevant. And I think people creating status signals with products, that's one of the oldest things. If you wear like a Rolex watch, there's a signal there, but the problem here is a combination with market power, right? If you are Apple and you have 80% of the market and you can really stigmatize the 20%, that becomes potentially something to pay more attention to. That's all.
I'd like to thank you for the insightful presentation. Although I do have a practical question as for the app. Can you please explain the difference? How does your app differ from the feature that Instagram currently has, such as limiting activity after a certain time that is in advance had been set up?
Yeah, so that's so what the Instagram is doing is already in response to some of the litigations that are ongoing. And yes, I think it's definitely a step in the right direction. They're doing it at night, right, from 10 p.m. to 6 a.m. or something for under 16-year-olds, I think. Yeah, I mean, it's just a feature that allows for coordination. It's not just you. I mean, there are a lot of time blocking apps, right? The reason why they don't really work so much is because people understand the problems. Like, just giving me a tool to limit my use, yeah, that helps in the margin if I have self-control problems. But if I need a coordination tool, I need more than that. And that's where we're stepping in, yeah. We can talk about maybe the technicalities offline. Yeah, thank you.
Can I ask you a question?
Not about Brazil, but it's relevant in Brazil.
No, I was very intrigued by your presentation, and I have 2 kids, so I was thought, kind of trying to think this is in utility function form. So there is like a marginal disutility as you start increasing the usage. So what if you did an experiment that said, not you don't use it or you use it, but everybody can only use for 2 hours? Because I think for a lot of people, they like it to use it, but they don't like to have to use as much to be as influent to the extent that that actually is an impairment on their life. So trying to see what is the optimal amount of usage, and if people would be willing to migrate to that solution as an intermediate solution that you suggested.
Perfect. That's exactly what we do with the app. So we have, it's not about blocking, it's about a challenge where it's less than an hour per day and you coordinate. And there's another one that's 2 hours, 3 hours. Is that to move collectively to different equilibria. Exactly. Because look, we're not Luddites. We think technology is good, right? I mean, some social media usage is good. That's why I think like banning phones, I don't know, there's a lot of good things that you can do on your phone. So it's just about helping people coordinate to where collectively they'll be better off. This is exactly what we're doing. Yeah.
Thank you. So very, very interesting presentations. I want to ask now to Roberto. No, Roberto, before you were mentioning that a limit to innovation is maybe you can kill the banks, no? But it seems to me we are going to a financial system which we have highly regulated banks, and all the banks are extremely regulated. And at the same time, now we're creating a lot of innovations to undo what the banks used to do, no? And we have the functions of the banks operating somewhere unregulated. And you were at the central bank. At the end, if there is a crisis, the incentive is to bail out everybody, no? Or if you doesn't matter. I'm thinking on money markets. They were not banks, but when you have a crisis, you cannot allow institutions to go down. Don't you think that we are going towards this system of highly regulated banks and the non-regulated institutions, but at the end, the problems of moral hazards that justify regulations are there? How are we going to deal with this? And especially from the perspective of a central bank.
Okay.
When the crisis
That's
starts.
a good question. So first, I don't mean to say that I think the banks will cease to exist or will be fully disrupted. What I meant is, if banks don't move and the platform start to take their business away as it's happening, then that might happen. But this is if banks don't move. Now, banks are moving. You see a lot of banks are investing in platform. A lot of banks are actually creating banks outside to disrupt their own bank. And you can see that, in different places. So it's more like a lot of the traditional banks will become non-traditional banks and will join this platform. One other thing is, this is not true for the whole banking activity. This is true for retail. So if you look at a lot of the banks and you separate IB, which is investment bank, from retail, what I said only influences retail. For example, if you look at return on equity on a bank in US and compare to Europe, in US is relatively higher. And we had endless debates at the BIS, why is it that the return on equity on US banks are higher than Europe? Obviously, the European CEOs would go to the meeting all the time complaining that the regulations were to blame for that. Well, I actually did a little bit of a study on that, and that explains only a small part. Most of the difference between the returns on equity of US banks and European banks is IB. Investment banking. Investment banking is very big in US, and it doesn't exist in Europe. By the way, 70% of all the investment banking activity in the world is done in US. So again, the disruption of the platform banks apply more to the retail business to the wholesale business. And there are banks that are actually reinventing themselves, fighting different niches. So I'm not here preaching that the banks are going to be disrupted and it's going to be a problem in the financial intermediation. On the contrary, I think the platform banks are actually going to force the banks to be more competitive, and the open data system will actually create segmentation in the financial service in a way that the clients will be better served at a lower price with more competition.
Quickly to know, what's the average transaction amount that you're talking about or that you're aiming at when you're trying to open up the retail banking transaction fully integrated? We haven't been able to integrate healthcare, which is probably as important as banking. Are you talking about transactions in the order of like $100, $200, or you're talking, what's the top of these transactions like? Because there's a lot of regulation in the middle that can't be skipped, right?
If I understood your question correctly, on the instant payment system, what is the average amount of the transaction? Okay, so in every instant payment system, there is a similar pattern that happens. It starts on P2P with very low tickets. And as the system evolves and people gain trust of it, the ticket size starts to increase. You start to have P2B and eventually B2B. When you look at Pix, it started almost solely as P2P, and the ticket was very low. Then you started to have P2B, and now you're having a little bit of B2B, which means that the ticket size is increasing. But in Pix, we have a ticket size of millions of reais. It happens. It's not very often, but it happens. But the average size has increased a lot. I don't have the exact number in my head, but it has increased by at least 10 or 20, around 15-fold. So it is increasing.
Roberto, what do you think would be challenging for starting this kind of PIX thing here in the United States, where they still use fax when we have email? Sometimes they prefer fax machines. And money order, something like money order, and you pay like $20 for a transaction, very small ticket. What do you think are the challenges in this market?
Okay, so I guess the question is why US haven't reached a stage of evolution in the payment space as to have a lot of instant payment system working as well as in some other place like Brazil and India. But there are a lot of reasons. But when you're putting together a system like Pix or UPI in India, there are a couple of things that actually help you in the beginning. So if you don't have a lot of banks, it helps you a lot because there is a coordination exercise in the beginning. So when you have a case of Brazil in which 5 banks own 80% of the deposits or something like that, then once you coordinate with the 5 banks, everybody else is going to join because nobody's going to be left out. If you have a place or country in which you have 2,000 banks, then it's more difficult. The second thing is whether the regulation allows you to use mandatory rules. So I go to the banks and said, okay, this is the new system of payments, and by the way, you have to use it. It's not optional. In some places you can do that, like Brazil. In some other places like Colombia, you can't do that. And so you have to try to use moral suasion and convince the banks that actually they have to gain from that. An exercise that was done in PIX is when we first thought about the system, we knew the banks would lose money from charging the fees of the transaction. It was around 20 billion reais, more or less, give or take. So when the banks look at that in the first place, they said, I mean, we would never do that on our own because nobody wants to, just, lose 20 billion in transactions. And one of the debates that I had with CEOs of banks, and I said, but you're not seeing the thing here. We're going to change the system. You're going to eventually make money from that. Nobody believed in that. And I actually made a bet with one of them, and I said, if in 4 years you're not making more money with PIX than you're losing from what you're charging on the transfers, then I was wrong. Because at some point in time, some of the banks, they thought, these guys are creating a system that is just going to replace one payment system for the other. And that's not what we're trying to do. We were trying to do a payment system that was a rail, that was programmable, that would generate inclusion. So 71 million people open bank accounts just to have PIX. So you get fees from accounts that are open. You start having products that you can put on PIX, for example. Now the banks realize that they don't need Visa and MasterCard in Brazil. Pretty soon they won't need them. They can do the credit card function within PIX. So it's going to save a lot of money from the bank. So the hard part is to convince them that they're going to be better off in the future because they're not seeing the way from here to there. That was probably my biggest challenge.
So I don't have time anymore for questions, so I suggest we have a 10 minutes break for further questions, and we'd like to thank our keynote speakers. So don't forget, we have a last panel just after the break.
Vamos ser eficientes.